Good evening, America. Welcome back to Market Insights Daily, your no-nonsense guide to what's really driving the markets and your money. From Wall Street's high-rises to California's golden shores and Iowa's vast farmlands, thanks for tuning in. I'm your host, Ryker Dean, and tonight we're unpacking a market meltdown that erased $7 trillion in 24 hours, the most brutal gold and silver crash in decades. Was it a natural shakeout or something more orchestrated? Stick around as we expose the red flags every investor needs to see. Picture this, it's a typical Tuesday morning on Wall Street, but by the close, the precious metals sector is in freefall. Gold, which had been riding high at around $5,390 an ounce, cratered nearly 9% in a single session, bottoming out just under $4,900. That's the steepest one-day drop since the wild volatility of the early 1980s, back when inflation was raging and the Fed was hiking rates like there was no tomorrow. Silver got hammered even harder. At one point, it plunged more than 35%, marking the largest single-day collapse on record for the white metal. To put that in perspective, if you combine the market value erased from both gold and silver that day, we're talking about a staggering $7 trillion vanishing into thin air within 24 hours. That's not pocket change. That's enough to fund the entire U.S. federal budget for months. For context, imagine waking up to find your 401k or IRA slashed by a third overnight. That's the kind of pain retail investors felt if they were heavily positioned in these assets. Now, if you're new to investing or just dipping your toes into precious metals, you might be wondering, what sparked this meltdown? Was it a sudden shift in economic data, a geopolitical breakthrough, or something more technical? The truth is, this wasn't your garden variety correction driven by fundamentals like interest rate changes or supply disruptions. No, this was a classic positioning shock, a brutal unwind of overcrowded trades built on leverage, speculation, and euphoria. To understand why, we have to rewind the clock and look at the buildup. Over the past year, gold and silver hadn't just been climbing. They'd been in a full-throttle bull run that would make even the most optimistic Wall Street bull blush. Silver, for instance, rocketed from about $31 an ounce to over $116, a jaw-dropping gain of nearly 280%. Gold nearly doubled, surging from $2,760 to north of $5,400. And in January 2026 alone, gold tacked on almost 30%, while silver exploded by close to 70%. That's not sustainable growth. That's a momentum frenzy, fueled by a perfect storm of factors. What drove this surge? For starters, persistent inflation worries here in the U.S. With consumer prices still hovering around 3 to 4% despite the Fed's efforts, many Americans turn to gold and silver as a hedge against the eroding value of the dollar. Then there's the geopolitical tension, ongoing conflicts in Ukraine and the Middle East, trade spats with China, pushing investors towards safe haven assets. Central banks around the world, including our own Federal Reserve, were snapping up gold at record paces, adding to the upward pressure. And let's not forget the retail frenzy. Social media influencers and financial pundits hyped gold as the ultimate get-rich-quick play, painting pictures of it replacing the dollar or skyrocketing to $10,000 an ounce. Videos went viral claiming gold was the only way to protect against a collapsing economy, drawing in novice investors chasing quick profits. By late January, both markets were screaming overbought. Technical indicators like the Relative Strength Index, RSI, were pegged in extreme territory, and sentiment surveys showed euphoria levels not seen since the dot-com bubble. But here's where the red flags start waving. When markets get this crowded, with everyone piling in on the same side of the trade, they become vulnerable to sharp reversals. Leverage was everywhere. Futures traders betting big with borrowed money, ETFs like GLD and SLV seeing massive inflows, and even everyday folks using margin accounts to amplify their positions. Stop-loss orders clustered just below key levels, ready to trigger a cascade if prices dipped. And the sentiment? It was borderline irrational. Remember those viral clips screaming that gold would destroy the dollar, or that silver was headed to $200 overnight? That's classic hype. Great for clicks, but dangerous for portfolios. As an American investor, you've seen this movie before. Think of the GameStop mania in 2021 or the crypto boom-bust cycles. When too many people chase the same sure thing, especially with leverage, the unwind can be merciless. The immediate trigger? It wasn't economic data or a supply glut. It was political. All eyes were on Washington that day, with the surprise nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh, a former Fed governor known for his hawkish stance on inflation during the 2008 crisis, was seen by markets as a signal of tighter policy ahead. Whether that's accurate is debatable. Warsh has recently talked about cutting rates to support housing and growth, aligning more with President Trump's pro-economy agenda. But in the moment, traders interpreted it as a reduction in perceived risks, less chance of runaway inflation or dollar debasement, which had been fueling the gold rally. That shift popped the speculative bubble. Prices started slipping, volatility spiked, and the dominoes fell. Leveraged positions hit margin calls, forcing automatic sales. Stop losses triggered en masse, accelerating the drop. Liquidity dried up, buyers vanished as sellers panicked, and what started as a mild pullback turned into a rout. This is what experts mean when they call it a liquidity event. It wasn't about gold or silver suddenly losing their luster as safe havens. It was about the trades becoming too hot to handle. Fundamentals didn't change overnight. Inflation data was steady, monetary policy expectations held firm, and no central bank dumped reserves. It was pure positioning. Overbought assets, overcrowded with speculators, unwinding in a flash. For U.S. investors, this is a stark reminder of market mechanics. We love our freedom to trade, but with great leverage comes great risk. Think back to Black Monday in 1987 or the flash crash of 2010. Similar dynamics where technical factors amplified moves beyond fundamentals. Now, the big question on every American investor's mind: can the gold bull market roar back, or is this the start of a longer downturn? The honest answer? It depends. And that's not a cop-out. It's the reality of investing in a volatile asset like gold. Let's weigh both sides fairly, because as Americans, we pride ourselves on balanced views before committing our dollars. On the bullish front, there's plenty to like. Central banks worldwide bought over 1,000 tons of gold in 2025, a record pace, as a hedge against currency risks and geopolitical uncertainty. The U.S. dollar's strength could wane if the Fed cuts rates further. Lower rates make non-yielding gold more attractive compared to bonds or savings accounts. Inflation, while cooling from 9% peaks in 2022, remains sticky above the Fed's 2% target, eroding purchasing power and driving demand for hard assets. Geopolitics aren't going away. Tensions in the Middle East, trade wars with China, and election year uncertainties here at home all support gold as a portfolio diversifier. If the dollar weakens further, perhaps due to our ballooning $35 trillion national debt, gold historically shines, as it's priced in dollars and benefits from a softer greenback. Add in supply constraints. Gold mining output is flatlining, with major producers like Newmont and Barrick facing higher costs and depleting reserves. Demand from tech, electronics, EVs, and jewelry in growing markets like India keeps the floor firm. But flip the coin and caution lights flash. Gold isn't cheap by historical standards. Adjusted for inflation, it's trading at about 3 times its long-term average, levels that have preceded lackluster periods before. Remember 1980? Gold hit $850 an ounce, over $3,000 today adjusted, then languished for years as rates rose and stocks boomed. Or 2011, when it peaked at $1,900, $2,500 adjusted, only to slide for 4 years. We're in similar territory now. Gold doesn't generate income, no dividends, no interest, so its value hinges on sentiment. If economic stability returns, say with Warsh steadying the Fed and Trump's policies boosting growth, safe haven demand could fade. The strong dollar, fueled by U.S. exceptionalism, our tech dominance, energy independence, often pressures gold lower. And volatility? Gold swings can be brutal. 10–20% corrections are common, testing even the steeliest nerves. Silver's story is similar but amplified. It's more industrial, 50% demand from solar, EVs, electronics, so economic slowdowns hit harder. That 35% plunge? A stark warning. Silver's beta, volatility relative to gold, means bigger ups and downs. For U.S. investors, remember 2021's silver squeeze attempt. Prices spiked to $30, then fizzled. Hype can inflate bubbles, but physics, supply-demand, wins long-term. So what's the takeaway for you, the American viewer building wealth in this dynamic economy? Gold and silver aren't get-rich-quick tickets. They're tools for preservation, not speculation. If you're eyeing them amid 2026 uncertainties, like potential rate cuts or election volatility, do your homework. Ask, can I stomach a 20–30% drop without panic selling? Is this 5 to 10% of my portfolio as diversification, not the whole enchilada? For everyday folks, physical coins or bars offer tangibility, but storage and liquidity matter. ETFs like GLD or SLV provide ease, but watch fees and tracking errors. Miners, GDX ETF, amplify gains-losses with operational risks. Avoid the hype traps. Those screaming, "Gold to $10,000," often sell newsletters or coins. Conflict alert. Instead, view gold as insurance against dollar debasement or crises. Historically, it preserves purchasing power over decades, but short-term, volatile. In the U.S., with our robust stock market, S&P up 20% in 2025, a balanced portfolio, stocks, bonds, 5% gold, often outperforms all-in bets. This event underscores market risks. Leverage amplifies pain. Crowds create fragility. As Americans, we're resilient. Adapt, diversify, stay informed. If gold fits your risk tolerance, buy on dips, not peaks. But remember, true wealth builds from productive assets, not just shiny ones. Thanks for watching. If this helped clarify the gold chaos, hit like, subscribe, bell for more. Comment, gold hedge if you're allocating, or too risky if skipping. Stay smart with your investments. Your future self thanks you. Disclaimer. The information presented in this video is for educational and entertainment purposes only. It is not intended to be and should not be construed as financial, investment, legal, tax, or professional advice of any kind. All discussions about markets, commodities, or economic trends are based on publicly available data and general analysis as of February 2026 and may become outdated or inaccurate due to changing events. Investing in commodities, stocks, ETFs, or any financial instruments involves significant risks, including the potential loss of principal. Past performance is not indicative of future results. Viewers should conduct their own thorough research, consult with qualified financial advisors, and consider their individual financial situation, risk tolerance, and objectives before making any investment decisions. The creator of this video is not a licensed financial advisor, and any opinions expressed are solely those of the narrator and do not reflect the views of any affiliated entities. We do not guarantee the accuracy, completeness, or timeliness of the information provided. Links or references to third-party sources are for convenience only and do not imply endorsement. By watching this video, you agree that the creator shall not be liable for any losses or damages arising from your use of this content. Always verify information independently, and remember, no investment is risk-free.